All right, everybody. Welcome to today's episode. We have a special guest with us. I'm sure you're well aware of him. I talk about him frequently, and I talk about his spaces frequently that he has on Twitter. He's a 5 times Dow Award winner writer. Risk on, risk off. RoRo is his ETF that he runs, and the Junk on, Junk off JoJo ETF. He also has the ATEX Mutual Fund, and he runs the lead lag report as well. Am I missing anything there, Mike?
I somewhere asleep. I got to put it in there. As I think
Yeah,
the way
got to
that,
sleep
yeah,
somewhere. Does not like Batman movie, as we all know from his recent tweet as well.
was atrocious.
Yes. Mike, the market's been all over the place and people are kind of losing their minds a little bit. There's people on both sides of the spectrum, like super bearish, super bullish. And one thing that I've noticed is when volatility starts trending, this is typically what happens. People become uncertain and people look for certainty. So they try to like fly into one direction and not really kind of understanding the other aspect of things. That's why I want you on. I need a professional to talk to us a little bit, calm our minds, and let us know a little bit what's going on and what we should basically be looking for.
So the good news for your audience is that I have no goddamn clue what's going to happen either. All right, so hold on, and because I'm half joking when I say that because this is as I keep referencing, this is one of the most difficult and frustrating junctures. As somebody that's been in the business, has skin in the game, this is one of the most frustrating, most difficult junctures I've ever seen, right? And I know people will say that in dramatic ways, but this one really is very unusual. Okay, so the way I frame the way markets are behaving here, this is like going through hell, and the only way to go through hell is to keep going, right? And why am I saying it's like going through hell? Because it is wildly unclear how the market directionally will play out. So if you look at the way the stock market acted starting this year, 2022, you had out of the gate a very sudden and sharp decline as yields themselves started rising, bonds sold off, stocks sold off, everything started selling off except, as we know, commodities, which we'll touch on. And what made it so unusual, especially in January, is that you had this broad-based sell-off across the board, and yet the historical leading indicators to volatility, which are what those different papers are known for, as documenting getting ahead of major crashes, corrections, bear markets, they were not telling you that a decline was coming, right? And if anything, the decline, I would argue, that we saw that started in January did not look by any means like classic risk off, because you did not have utilities outperform in that period. You did not have treasuries, as we know, outperform in that period. You have this unrelenting streak even to this day where stocks go down and long duration treasuries also go down. Very unusual, because usually treasuries are the flight to safety asset where money goes to when volatility picks up in equities. So you had all that happening, and what I've kept on arguing continuously is not risk off, even though direction of the stock market's going down. And a lot of people that track my work and see me on Twitter, they kind of roll their eyes. How could you say that's not risk off? Well, risk off is about certain behaviors, not just about direction. The behavior that was the most at odds with the direction of the stock market was the behavior of credit spreads. So usually when you look at volatility spikes in equities, you will see junk debt widen relative to nominal treasuries. So the bond market starts to price in default risks, starts to price in more volatility. So you see a spread differential widen.
Is there a good chart that an individual can pull up to see that themselves?
So the simplest way to do it, to at least give you a sense of kind of where things are going, at least directionally with spreads, is to do a ratio chart of high yield. So if it's something like the HYG ETF,
okay,
divided by IEF, which is the nominal 7 to 10 year treasury. There's a slight duration mismatch, but you still get roughly to the same conclusion about spreads moving. So you can kind of track that every single day and see what's happening. So my point is that ratio stayed pretty much in line. You never saw high yield break down relative to nominal treasuries as equities are going down. Okay, now, only now, after already a fairly big decline, and last week was a pretty pivotal one, are you starting to see real risk off behavior. Utilities went vertical relative to equities, relative to the S&P 500. That's what you see in advance of a correction, not lagged, not coincident, as a leading indicator. So that's a little curious to me. Mm-hmm. Oh, long duration treasuries are still not outperforming, but I think you're going to start seeing some reversal there. And then lumber to gold, which has been wildly frustrating this year, only now looks like it's starting to break down. Now, lumber is so funny because everybody talks about how gold has behaved this year as a risk off asset. Lumber's outperformed gold, which is really, really freaking weird because usually most corrections, most volatility periods have lumber weak in advance of it. Not this time. Right. And for me, going back to my frustration, that's been very difficult because that means my Roto ETF, which uses the lumber to gold relationship, has been risk on throughout this entire move. And when it's risk on, it's 1.3 times equities. Now, terrible period, right? Even though the index that it seeks to track has done very well, this has been a nasty juncture because of a false signal. All right, now I'm giving you a long-winded answer because I think this is important to contextualize things. Why am I saying this is wildly uncertain? Okay, because only now these leading indicators are starting to say risk off. And you can paint a very dark scenario where these grocery price shocks, which are coming, can really create significant demand destruction and potentially even a recession. Okay, because literally people will be choosing between going to work, hopping in their car, paying exorbitant gas, or paying for milk. I mean, you're going to get to that point given the way the ag space is behaving. So you can paint a very bearish case here that with Ukraine, Russia, this is going to take longer than people think, that you're going to have nationalization of resources and the commodity space is so underinvested that there's a real shock in terms of consumer prices for things that we need just to survive. And that would send stocks lower. That would cause spreads to widen as we've seen now. So that's your real bearish case. But there's also a really bullish case, okay, which is what makes it so difficult, which is that you can also argue this is the perfect contrarian setup, meaning that it's very possible that since we've been, I would argue, in a bear market since February of last year, you're talking about a year of weakness, of unrelenting underperformance by the vast majority of stocks underneath the surface. These areas are also due for a relief rally. And you look at sentiment surveys, they're as dark as March of 2020 with COVID. And so you look at all that, you say to yourself, okay, well, that's really interesting, right? Because you really don't know how this can play out. All you know is that likely these divergences are going to resolve in an extreme way. And I know that doesn't really help many people that are listening to this. It doesn't help me either because I'm running funds that are risk on, risk off. But this is just one of those really historic moments from an intermarket perspective.
I would have to agree. Absolutely. That's some really good insight. There has been a lot of interest in, let's kind of just switch over to small caps specifically, because you had mentioned on prior episodes that lumber to gold, right? So when lumber is performing well, you typically can see small caps perform as well. And if you want to give the reasoning as to why that is, that'd be great. But what we're seeing right now is IWM Russell 2000 seems to be more kind of just holding up pretty well. It's not like it's performing that great, but it's holding up relative to the other indices. Could that be some insight into potentially something that we could be finding a short-term bottom or something like that?
Yeah. Okay. So good question. Okay. So why is historically, this is not my opinion. It's just from a backtest perspective.
Okay.
Historically, when lumber outperforms gold, small caps tend to outperform large caps. What's the reasoning for that? Because if you go with me that lumber is the most cyclical commodity of all because it's the key determinant or tell of housing construction. Well, then if lumber is strong, housing is strong. If housing is strong, the wealth effect is improving. Domestic consumers have more capital, more credit, and all that should benefit small caps because they are more sensitive to the domestic economy than multinational large caps. Right. So historically, usually you see small caps outperform large caps when lumber's strong. Now, you haven't seen that at all, by the way. You didn't see that last year with the lumber to gold, surge and small caps going sideways. You didn't see that in the second round where lumber surged. Now, this is like kind of very almost like asynchronous behavior, right? Which goes back to why this is such a screwy environment. And again, it's not my opinion. This is based on historical behavior going back to 86. This time around, I just mentioned lumber to gold looks like it wants to break, but to your point, small caps relative to large caps are actually holding up relatively on a short-term basis better in the decline. Now, I made this point before that going back to the bull contrarian case, small caps have looked like death since February of last year. They have underperformed dramatically large caps despite all of the stimulus. So small caps are themselves arguably due for outperformance against large caps. The question is, can you really have outperformance in small caps relative, right? Small relative to large, if directionally you still have a correction? And that seems to be what's happening here, meaning that small caps basically go down less than multinational large caps while both are declining. I'm saying that's unusual because small caps you would think should outperform large caps in an uptrending market, not a downtrending market. So it's holding, arguably because you can say it's been so washed out relative to large caps, and maybe just doesn't want to follow the lumber to gold relationship for any number of reasons here. But it is interesting, right? Because I would argue that either way, if you're going to have a bull move or that kind of melt up, shock move higher, contrarian setup, small cap should benefit the most. If you are going to have a resumption of the correction or bigger decline still coming, which I'm tilting more towards, it's probably going to be hitting large caps more anyway.
Yeah, when I look at companies, the mega cap stocks, so Google, Tesla, Microsoft, when you zoom out of a chart, you really see that they haven't really been hit all too hard yet. I mean, they're down on the year pretty significantly, but if you back up 3 or 4 years, even 5 years, there's a lot of room to go down. And if those big cap stocks continue to just sell off or more sell side activity takes place, what is your take on that? Will that impact the markets quite significantly?
Yeah, I think unequivocally. And I mean, Tesla to me is the canary because that's the most loved stock that most people focus on. And it's such a big driver of the indices now that I kept on making this joke on Twitter that, Tesla is basically fucked, right, in terms of the stock price movement. And I'm saying that only because when you have, it always goes back to that line I keep using on Twitter, which is that when an investment becomes a religion, it's time to lose faith, right? And I've often applied that to the cryptocurrency space, right? When I see this kind of sentiment, but clearly you can say that about, Tesla, right? And people seem to forget when it comes to Tesla that a stock is not a company. This to me is always what's always mind numbing about people that come back as far as, oh, the stock price is going to do this or that. It's like, okay, stock price can be completely divorced from the actual valuation on the equity side, right? So I think you're right. Look, there's a lot of vulnerability, and we saw it with Facebook, we saw it with PayPal, we saw it with some of these other mega cap names that they can gap down hugely. It can happen overnight, right? And that's where you get another pulse lower. So we're in a year where things are just very dangerous, very difficult, and you can't really be comfortable with whatever the prior narrative was.
Yeah, that makes sense. When I look at year-to-date performance and I just look at the 11 sectors that make up the S&P 500, everything right now is in the red. And it used to be, financials were kind of up there and energy clearly was up there, but we're starting to kind of creep up. Utilities now is in the second place and consumer staples isn't too far off. But what I did find interesting is this past week of trading is consumer staples got attacked and utilities now is showing a little bit more relative strength, significant more. And is that something that people should pay a little bit more attention to other than consumer staples? And maybe your insight as to why would consumer staples start getting hit when it's more of a defensive type sector?
So utilities, as you know, are going to be much more domestic, right, in terms of the makeup of the sector. Consumer staples are going to be much more global. So it kind of makes sense given what's going on with Russia, Ukraine, that at the margin, you're going to have some of these companies no longer being able to sell in Russia, right? And at the margin, that can be a big driver of earnings and impact them from a valuation perspective. So to me, it's more like a domestic versus global argument. Even though, to your point, usually when utilities outperform the S&P, consumer staples do too, because they're both dividend plays, defense plays, need plays, right? That money will flow to when there's uncertainty, or at least the illusion of uncertainty. Now, the utilities move is going to be really interesting, not from the standpoint of utilities, but from the standpoint of, will you now start to see treasuries again act like a risk-off asset class, where TLT as the proxy, for example, the long duration 20-year treasury ETF goes up in price, yields go down, as the stock market then goes through another leg lower, if you go with the bear argument. Now, again, I go back to usually utilities, when they outperform, that will happen at the same time long duration treasuries are outperforming intermediate. So TLT relative to IEF. That tends to outperform while utilities are outperforming the S&P. Why is that? Because they're all plays on interest rates. Right? Utilities, most bond-like sector. Demand for money changing benefits utilities. If that demand for money is falling, because it means rates are going to be cheaper. And you would expect to see then long duration yields fall with that. You haven't seen that this year. Right? Treasuries, as we know, keep on selling off. Treasuries selling off, I would argue, has been to the benefit of gold as the risk-off safe haven alternative, at least for now. And everyone, I still think, is of the opinion that treasuries will keep selling off and yields will keep rising. But I have to tell you, I don't believe this stagflation argument one bit, because I don't think the system can survive under stagflation, where stocks are falling and treasury yields are rising. This is not like the 70s, because in the 70s, you had way less debt than you do today. At some point, when the numbers, when interest rates are high enough and spending is high enough, you end up getting to a point where if yields keep rising, it's basically your tax base that goes to interest expense. So the system cannot survive under a stagflation environment where yields keep on rising on the long end. So there's going to be a natural stopping point where treasuries again get the bid. TLT again starts to rally in price, drop in yield. I think that will confirm sort of the next leg lower, where you get that convexity where treasuries massively outperform equities. And candidly, I really do need that also, because whether it's ATAX, my mutual fund, RORO, JOJO, they all get most of their alpha historically from a testing perspective and from a live perspective when it comes to mutual fund, from getting that risk off treasury trade, right, where treasuries massively outperform as equities go down. You haven't seen that yet, but I think that's the next major thing to watch for.
Do you think it's going to be a catalyst-driven event where something's going to take place or something's going to break to make the sudden shift and change, where we kind of see it taking place right now, but then there's going to be some sort of a headline to hit the tape?
You know, it's interesting. I don't know if it's catalyst-driven, but play it out here, because there's also a relationship to the dollar, right? Because the dollar has been unrelentingly strong, which is very unusual, right? By the way, because everyone always thought that printer go burr, right, and the dollar will go down. And to Brent Johnson, who I think you saw, I've had him one of my spaces. He has this theory he calls the milkshake theory, that the dollar goes up, you have a sovereign debt crisis, and it actually ends up benefiting U.S. equities over time. But you have this kind of strange behavior where there's a flow of money going into U.S. and that pushes currency higher. So the dollar has been so strong. If you were to get like a real spike in the dollar, well, then I'm pretty sure foreign investors would say, I want to go into the U.S. because now I benefit from the currency, and now I'm also getting a higher yield than I did 3-4 months ago. So I can see a scenario where that alone becomes a reason for yields to drop, because demand from foreign investors starts to come in. And I do think it is very possible that it's never the obvious, it's always the secondary or tertiary thing nobody's talking about that ends up being the bigger risk. Okay, the bigger risk could very well be, yes, that Russia-Ukraine gets worse. But I'm sure you also noticed this last week, that there's something really disturbing happening with China stocks, okay, and China tech names in particular. We know about the crackdown. We know about the regulatory pressure here in the U.S. But I have this nagging feeling, and I've only had this just the last couple of days as I keep thinking about what's happening. I do wonder if, just like the U.S. knew that Russia was going to go into Ukraine, because they have all the intelligence, they have all the all the people that do the work to know this stuff. I do wonder if there's a sense that they're trying to get ahead of a potential invasion by China in Taiwan, and that they're trying to front run that by trying to get out of any kind of potential financial market scenario where China equities are around, people get stuck in it as China then goes into Taiwan. I don't know, right? But you always have to kind of read the tea leaves a little bit as to why things are happening. It's like you have Russia, Ukraine on one hand, but suddenly China is getting hit far more.
Significantly, yeah, absolutely. That's some good insight. A lot of things that are, or one of the things that are on people's mind is inflation, and we kind of touched on it a little bit. So I want to kind of direct there. What do you see taking place in this environment, given how inflation has been on this rampant run? Are we starting to hit, a period where the rate of inflation is going to start to peak out and things are going to settle down, or are things for everyday people going to continue to just skyrocket? And if so, what does that look like for the average individual?
So first of all, it's interesting. I keep alluding to this on Twitter on @Lead Lag Report, that we were asked to stay at home for COVID. Mm-hmm. And so work from home became really a thing, obviously 2020, 2021. And then everyone's hoping that people go back to the office. But the problem is now when you go back to the office, the price of gas is pushing like $10 a gallon. So I wonder if we're going to see another surge back in work from home, because the cost of actually going to work is going vertical, right? So just more of a kind of an interesting side note about this inflation discussion. And I keep making this point that it's inflation now, deflation later, right? Because going back to food prices, gas prices, kind of things that we need, the way that these things are going vertical, if it holds, and of course that's the caveat, right? The price can't just be there for a week and then come back down. If the average price stays elevated, it's going to create demand destruction. So it looks like inflation, but then inflation really is actually, I would argue, disinflation, deflationary, because it creates demand destruction. people literally will not be able to buy discretionary items like they used to because they have to feed their families. So you end up having this kind of inflationary juncture here, but that I would argue ends up being disinflationary because it takes consumer discretionary spending out of the equation. So I think that people are massively underestimating how much more grocery prices are likely to be in the coming months. I think it's going to be shocking. We are in the business, we see this, and we know that this stuff takes time to work into the economy. But when you see wheat doing what it's doing, when you see corn doing what it's doing, and by the way, these staples have been strong even prior to Russia invading Ukraine, right? It's not like this is like a new story. I know the administration's going to make it seem like, oh, this is all because of Russia. No. The inflationary pressures have been building for a while because the Fed overreacted to COVID, and so did the fiscal stimulus side. Right? There's a massive overreaction, money printing everywhere. So everything works on a lag. So it could very well be that we are stuck for a year or two with very, very extremely elevated food prices. That alone could create a recession, and recessions tend to be disinflationary, deflationary. So I think the inflation-deflation discussion is a little bit more difficult to think through because it's about the time frame and what the implication of a shock in inflation actually means for longer-term deflation.
Would you say that a recession could be very well imminent at this point?
We could be in it.
We could be in it.
This is the thing about it's like the National Bureau of Economic Research, NBER. Oftentimes when they announce that we're officially in a recession, it's already happened. It's already taken place, right? And it's always about definitions, right? It's like recession. I believe from an economics perspective is 2 consecutive quarters of negative GDP growth. Well, I'm pretty sure inflation is probably higher than the reported number, which probably means that real GDP, meaning after inflation, probably is 0 to negative right now. Right? After inflation, we're not growing past the rate of inflation when inflation is this high. So we could very well be in it already. And that could be why everything has sold off. I mean, if you go with the idea that equities are supposed to be a leading indicator, which you can argue is debatable given how much of a driver of the wealth effect it is, right, it could very well be that we're in it now. And it's not going to be announced until 4 or 5 months from now.
That's a good point. Are you keeping your eye on the yield curve as a potential indication of that? And should other investors keep their eye on that as well? For example,
yeah, I mean, so if you get the kind of inversion on the yield curve and you're flirting with it, here at these levels, keep in mind, I think a lot of people forget that you don't need to have an inversion to have a recession. Right. It's like Japan hasn't had an inversion, I think, since the early 90s, but they've had like 6 or 7 recessions between now and then, right, without the inversion. So, and everyone talks about it, and the media talks about it, but the reality is you can have a recession without it inverting. The bigger concern here is what the hell are people going to do? Because if you really think it through, you've got inflation skyrocketing, all the inflation hedges that people thought they could rely on, Bitcoin stocks, well, now they've lost money. The dollar is going up in a very strong way. Prices are going up in a very strong way, and you actually lost significant net worth, given the correction so far this year. It's a double whammy. Not only is the price of goods higher, but then on top of that, you actually lost money on an absolute basis. So it gets accentuated. So this is why I go back to I lean more towards now the bigger risk off is coming probably sooner than people think, because that demand destruction has yet to really start to be realized by people. And it certainly has yet to be realized by the housing market. And if the housing market starts to now respond to this potential shock in the economy, that is really going to accelerate things on the downside.
Well, we got a lot of insight from you. I want to just close off with just one final note and just talking about cryptocurrency. I know it's on a lot of people's mind because, well, they've been in it for the last couple of years. It hasn't really gone anywhere. I'm trying to figure out how to word this. How do you think that Bitcoin now, as big as it actually is, and market caps with all the other currencies, do you think that if we do have a real severe risk-off event, that it could be significantly bigger and affect Bitcoin because of just how large it has been? And just to give like other people an idea what I see out there, and I know everyone does, but when you mentioned like Colts, right? And it just like, I just don't understand like how people are so focused on one single asset and how they're putting everything into it. I mean, I get it to an extent, but whoa, it's crazy. It's absolutely.
Yeah. I mean, it always goes back to to narratives when you cannot value something. Narrative is all you have, right? I mean, when you can't actually fundamentally value something, it's narrative, it's momentum. And sure, yeah, listen, no question. Look, for all we know, this whole thing could end up being exactly what the Bitcoin maximalists believe is going to happen, which is that you have a great reset and everything gets priced in Bitcoin. But I keep going back to, if you priced wheat in Bitcoin and Bitcoin City and El Salvador were up and running, that would cause literal mass casualties because people would not be able to eat, right? So I always go back to volatility as a key component to thinking about how anything could replace fiat. And going back to the dollar has been unbelievably strong. Well, if the dollar is strong, meaning purchasing power actually goes up, that seems to be actually maybe better than Bitcoin than people would think, at least in the last 2 years, right? Just the way that the way it's behaved, or last 1 year at least. So I don't know how to think about it in the context of where we're going, because clearly the correlation of Bitcoin can change relative to equities and risk assets. The one thing I keep going back to when it comes to Bitcoin and equities is that they have one thing in common, which is that they can both be overly levered. And I always go back to that point I keep referencing, which is that the necessary precursor to a crash in any asset class is significant leverage, which comes from overconfidence, which comes from narratives. So as long as that dynamic is there, at the end of the day, I'm going to argue that you're still going to have massive, massive drawdowns and massive, massive disappointments in both equities, cryptocurrencies, and everything that reacts off of this argument that the Fed controls everything, because the reality is it's all one big lever trade.
All right. I like it. All right. That'll close it up for today. Mike, thanks again for coming out. It's really appreciate it. I know my audience is going to absolutely love seeing you on here. For those that don't know who Michael Guyot is, I'd recommend you go follow him on Twitter at Lead Lag Report. I'll have it actually in the description below, as well as all of his white papers as well. I'd highly recommend everybody read those.
I appreciate it, Mike.
Thank you.